Picture this, it's 1929. The stock market has just completely imploded, wiping out fortunes and kickstarting the Great Depression. It was utter chaos, panic everywhere, and there was absolutely no reliable guide for how to navigate the financial wreckage. But right in the middle of all of that, a book was written that would literally change investing forever. And believe me, its lessons are just as critical today.
Now, you don't have to take my word for it. Warren Buffett, the Warren Buffett, maybe the most successful investor in all of history, called this book, Security Analysis, his personal roadmap. I mean, when a guide gets an endorsement like that, you really have to pay attention.
So, what's actually on this map? What are the secrets that have guided some of the world's best investors for almost 100 years? Well, it all boils down to one fundamental, really powerful distinction.
Before you even think about putting a single dollar into a stock or a bond, Graham Dodd basically insists that you stop. First, you have to understand what game you're actually playing. And this right here, this is the bedrock of their entire philosophy. And the way Graham makes this distinction is just crystal clear. An investment, he says, is like a business operation. You do thorough analysis. Your number one priority is protecting your initial capital, the safety of your principal, and you're aiming for an adequate or satisfactory return. Speculation, that's a whole different universe. It's just chasing prices, completely ignoring the underlying fundamentals of the business and taking on a ton of risk. So the first rule is simple. You have to know which game you've decided to play.
All right, so once you've made that choice, you're going to be an investor, not a speculator, then you can start building your framework. And that whole framework rests on two powerful, deeply connected ideas.
First up, intrinsic value. You can think of this as your North Star. As an analyst, your job isn't to be a fortune teller, guessing which way a stock price will wiggle tomorrow. Nope. Your job is to be a detective, to calculate based on cold, hard facts like assets and earnings, what a business is actually worth. The price you see blinking on the stock ticker, that's one thing. Its true underlying value is something else entirely.
And that leads us directly to the second pillar, the margin of safety. This is your shield. This is your buffer against the uncertain future, against your own mistakes, against just plain bad luck. Once you've figured out what a company's intrinsic value is, you don't buy it at that price. No way. You wait patiently until you can buy it for significantly less. That gap between the value and the price, that's your protection.
Let's make this super simple. Say you do all your homework and you figure out a company is truly worth about $100 a share. Well, you apply your margin of safety and decide you're not willing to buy it for a penny over $60. That $40 difference, that's your cushion. That is quite literally how you try to buy a dollar for 60 cents.
Okay, so we've got the philosophy. Invest, don't speculate. Focus on intrinsic value and demand a margin of safety. But how do we actually, do the analysis? Well, thankfully, Graham and Dodd gave us a specific set of tools for the job.
A huge part of their teaching was that you can't analyze everything the same way. You need the right tool for the job. So for something that's supposed to be really safe, like a bond, your main concern is just downside protection. You're asking questions like, can this company easily cover its interest payments? And are there enough real assets to back this up if things go wrong? But for common stocks, the focus totally shifts. Now you're hunting for value. You're digging into the balance sheet to find a company's sustainable earning power, the real, repeatable profit it can generate over the long haul. And what kind of information should we be focused on? Oh, the book is incredibly disciplined about this. It insists that your decisions have to be based on quantitative data, the hard numbers you can find in Verify and financial statements. All those qualitative factors, like a really charismatic CEO or some exciting story about an industry trend, they're always secondary. They might add a little color, but they can never, ever override the cold, hard facts. Okay, so we have the philosophy, and we have the tools. Now, let's roll up our sleeves and actually put them to work. What does finding one of these bargains actually look like? So this is one of Graham's most famous techniques, the net-net bargain hunt. It's a really extreme form of value investing. Here's how it works. You calculate a company's current assets, so cash, inventory, things that are easily sold. Then you subtract all of its liabilities, both long and short term. If the number you're left with is still higher than the company's entire market price, you've basically found a business that's worth more dead than alive. Talk about a huge margin of safety.
But here's the thing, finding the bargain is only half the battle. You also have to have the right mindset to see it through. That means diversifying your investments so one mistake can't sink your whole portfolio. It means being incredibly patient because it can take a long time for the market to realize a company's true value. And maybe most importantly, it means learning to ignore what Graham famously called Mr. Market, his metaphor for the market's wild, manic, depressive mood swings. Your job is to focus on the business's value, not the daily price quote. So let's just zoom out for a second. This book was written way back in 1934, with everything that's happened since. Wars, booms, busts, the entire digital revolution. How has this old roadmap actually held up? The legacy is just undeniable. I mean, it was literally born from the ashes of the 1929 crash, bringing a framework of logic to an age of pure fear. 15 years later, it completely captivated a young student named Warren Buffett, who would take these very principles and build one of the greatest fortunes in the world. And today, right now, its core ideas are just as relevant for helping smart investors navigate our own volatile markets. If you take away just one single thing from this, let it be this. Security analysis is not a book of stock tips. It's not a get-rich-quick scheme. It is a disciplined, rational framework for thinking about stocks as what they are, pieces of a business. And having that framework is your single best defense against the emotional tides of fear and greed that constantly define the market. Which really just leaves us with a final thought, doesn't it? In our world of high-frequency trading, crypto, and meme stocks, does a book written almost a century ago even matter anymore? Or just maybe, is its relentless focus on business fundamentals and a margin of safety the very thing we need most right now?